this session and to continue to work with Ranking Member Tillis to make life more affordable by lowering costs for consumers all across our country, and to ensure stability in our financial institutions that serve families, that serve our small businesses and communities in Georgia and around the country. I am proud of our efforts to ensure that communities have equal access to financial resources so we can build an economy that works for all Americans. I think that's in our collective enlightened self-interest. Today's hearing is about protecting Americans from junk fees in financial services, and it will examine the exploitative fee practices that fall under the jurisdiction of this committee. This includes unnecessary and onerous fees on bank deposit accounts, a topic I've examined before, as well as student loans in the rental, also in the rental housing market, and also small dollar lending. We understand that many fees do indeed help fund critical services and products. And so I want to say that at the outset. Not all fees are the same. Some fees are excessively high. Some fees are unclear. And some fees exist solely so that large corporations can pad their bottom lines on the backs of hardworking families. These fees provide no economic value. They're a drag on the American economy. In business school, economists call this, quote, rent seeking. But today I will say that what we all know they actually are. They're junk fees. And these junk fees are keeping hardworking Americans out of our financial system, particularly those who are already living on the edge of the economy. For example, 1/3 of unbanked households cite high fees as the reason that they remain without a bank account. And we know these types of fees affect poor people and people of color at a disproportionate rate. Since this subcommittee began our examination on fees, the good news is that some banks have now voluntarily made these changes permanent. And I applaud Zillow, Apartments.com, and AffordableHousing.com for committing to transparency in their rental listings. And more of their peers should follow suit and do the same. Let me say that this is not theoretical stuff for me. I've heard from Georgians about the harms of these fees. I've talked to the owners of small businesses, parents who have seen their children targeted while on a college campus. In the Consumer Financial Protection Bureau's request for feedback on fees, one Georgian serving in the military wrote about how technical glitches and shady businesses practices by their large bank cost them money and stress while they were preparing to deploy to a war zone. Protecting our service members is something that both the ranking member and I are serious about. And I'm glad that today on the Senate floor, we will be voting on my amendment to the NDAA to help prevent the harassment of members of the military by shady debt collectors. And I'm grateful for the ranking member's co-sponsorship of this bipartisan amendment and support bringing that into law. Our men and women in uniform should be focusing on their missions and caring for their families. They should not be nickeled and dimed by unscrupulous corporations, and debt collectors certainly should not be able to weaponize their service in pursuit of this practice. This is also personal for me. In addition to serving as the senator for Georgia, I still serve as senior pastor of the historic Ebenezer Baptist Church in Atlanta. And my church counts among its members Georgians from every walk of life, and we look out for each other. As a pastor and as a senator, I see my work as grounded in serving others and my community, and I want to extend this call to all of our nation's financial institutions to do the same. Love your neighbor as yourself. These fees don't just directly hurt families. Small businesses, which form the backbone of our economy, also face the brunt of predatory fees. The burden of excessive fees eats into their profit margins, reducing their ability to invest in expansion, to hire more workers, and to compete. By hampering small businesses' growth, these fees impede job creation and limit economic opportunity. As I often say, I think this is one more example where the right thing to do is also the smart thing to do. It's good not only for these individual consumers, it's the right thing to do for our economy. It's in our enlightened collective self-interest. I believe Congress and this subcommittee in particular have an important role to play in ensuring that the financial institutions that support our communities, our small businesses, and working families have the resources, the tools, and the support to continue their important work. At the same time, this is about our values. We must hold these businesses accountable when they juice their profits off the backs of hardworking Americans and ensure that they are not looking at these customers as easy targets to be taken advantage of with onerous and opaque fees. As a longtime student of Dr. King, this makes me think of words he wrote in his very last book, 1968 or 1967, Where We Go From Here, Chaos or Community. Dr. King said that the profit motive, when it is the sole basis of an economic system, encourages a cutthroat competition and selfish ambition that inspire men to be more I-centered than thou-centered. And so I'm focused on growing the middle class by lowering costs for Georgians and saving them money. And like all of my hearings, this hearing is about helping people, helping ordinary people, helping communities, helping small businesses to thrive by making life more affordable and creating jobs in the process. As American families, small businesses, and communities recover, we must ensure that they have the resources they need not only to survive, but to thrive. Thank you, and with that, I will now turn to Ranking Member Tillis for his opening statement.
Thank you, Chairman Warnock, for holding this hearing, and thanks to the witnesses for being here to testify. Any careful study of federal statute or regulations will be hard-pressed to find a formal definition for the term junk fees. It's quite simply because it doesn't exist. Though policymakers and regulators should certainly act against dishonest and abusive charges and practices, it is undeniable that the term junk fees is political in origin. So too, unfortunately, are the many regulatory actions that are underway on the issue. President Biden first announced his administration's initiative to combat so-called junk fees last October. This announcement, which broadly coincided with the looming election and levels of inflation not seen in 40 years, was widely branded as the administration's primary solution to the economic pain being felt by Americans. It's interesting that these fees, most of which had long been present in the economy, were suddenly identified as the drivers in surging inflation. Though nearly $2 trillion, the nearly $2 trillion President Biden opted to pump in the U.S. economy was somehow not. In announcing his initiative, President Biden directed federal agencies to reduce or eliminate hidden fees, charges, and add-ons for everything from banking services to cable and internet bills to airline and concert tickets, end quote. As the president's own words suggest, the scope of this initiative is exceedingly wide and vaguely defined, thus giving individual federal regulators tremendous latitude to act under the banner of junk fees. Chief among these regulators is the CFPB, an agency with a well-established reputation for pushing against its regulatory and jurisdictional boundaries. Similar to much of the CFPB's work over the years, several concerning themes have emerged in their efforts on so-called junk fees. First, the CFPB at times has offered various definitions as to what constitutes a junk fee in their eyes, muddying the waters for honest, good faith actors who are simply trying to comply with the CFPB's public stances. Second, the CFPB has resorted to one of its favorite tricks, engaging in naming and shaming campaigns. In actions taken on overdraft and insufficient funds policy, the CFPB publicized list of institutions that were all, by any reasonable measure, clearly abiding by the law, but not the policy preferences of the CFPB. Unfortunately, these coercion-style tactics were only encouraged by the Biden administration. Third, the CFPB continues to maneuver its policy actions to skirt around the Administrative Procedures Act, which is clearly designed by Congress to bring accountability and oversight to the rulemaking process. Through its reliance on blog posts, press releases, guidance, and statements of policy, the CFPB often mislabels its actions to avoid the rigors of the APA and minimize the likelihood of judicial review. Finally, as with much of their work, there is little to no evidence of the CFPB collaborating with other regulators or consulting them on implications of their policy changes. The wholesale changes of overdraft and NSF pushed by the CFPB certainly have significant implications for prudential regulation. Yet it's unclear if the CFPB sought feedback from the Federal Reserve or others. If not, this represents a serious instance of irresponsible regulation for political outcomes, not actions that promote safety and soundness in the U.S. banking system. For these reasons and others, many have concerns with the efforts led by the CFPB and the Biden administration as a whole on so-called junk fees. Reasonable people can disagree on policy. In Congress, we frequently do. But no one should find practices common at the CFPB acceptable. I look forward to the questions. I look forward to your testimony. Thank you, Mr. Chair.
Thank you so very much, Ranking Member Tillis, for your opening statement. And we turn now to our witnesses. Testifying today will be the Honorable Michelle Henry, Attorney General for the great state of Pennsylvania. Also testifying is Ms. Lindsay Siegel, who is the Director of Housing Advocacy for the Atlanta Legal Aid Society. And finally, our third witness is Mr. Brian Johnson, who is the Managing Director at Potomac Global Partners. We appreciate your testimony, and I look forward to this discussion about this important issue. Attorney General Henry, I will now turn things over to you.
Well, thank you. Good morning, Chairman Warnock, Ranking Member Tillis, and members of the committee. Thank you for inviting me to testify today. My name is Michelle Henry, and I am the Attorney General of Pennsylvania. I first joined the office in January of 2017 as a first Deputy Attorney General. I'll begin by saying this committee is right to focus its attention on junk fees because they harm both businesses and consumers. Honest businesses lose out to competitors who charge junk fees because the competitors' prices appear at first to be a better deal. Junk fees also prevent consumers from effectively shopping for the best overall price. In Pennsylvania, we have been working to protect consumers against junk fees. In the consumer finance space, we recently filed a multi-state lawsuit against Mariner Finance, a Wall Street private equity-owned installment lender. Our lawsuit alleges that Mariner charged consumers junk fees for hidden add-on products that consumers either did not know about or did not agree to buy. These hidden add-on products, such as credit insurance and auto clubs, are typically low or no-value products. Consumers left Mariner believing that they had entered into an agreement to borrow and repay over time a certain amount of money. In reality, because of these hidden junk fees, Mariner added hundreds to thousands of dollars to the total amount a consumer owned. The cost of the junk fees is staggering. For a random sample of loans originated in Pennsylvania in December of 2020, Mariner charged each consumer an average of $1,085 in junk fees for an average of $3,394 in cash borrowed. We also had a significant junk fee settlement in 2018 with Wells Fargo. This settlement stemmed from Wells charging its auto finance customers millions in junk fees. Despite evidence that many customers already had the required car insurance, Wells improperly charged more than 2 million accounts for forced place insurance. To resolve the multi-state action, Wells agreed to pay states $575 million. And although Mariner and other predatory lenders often argue that their overpriced loans are necessary to help consumers make ends meet in a moment of dire need, such as an unexpected car repair, we have found from empirical research that far more predatory loans are taken out to meet reoccurring expenses than for emergencies. Consumers in Pennsylvania often tell our office that they regret taking out their loans from a high-cost lender. Many times they tell us that the lender pushed them to borrow more than they wanted or needed. And often they were led to the lender by online lead generators that purport to be helping the consumer find the best deal available. In reality, most consumers would have been better off getting an auto refinance loan or an installment loan at their local credit union or community bank rather than going to an expensive installment lender that charges junk fees. We have also worked hard to stop hotel companies and concert promoters from charging junk fees. In 2020, we announced a settlement with a ticket seller that had been charging fees that consumer never agreed to, and it also refused to honor a refund policy. As part of that settlement, the company agreed to provide full refunds for all Pennsylvania consumers for events that were canceled. In 2021, we announced a landmark junk fee settlement with Marriott International. For many years, travelers had been misled by the published rates offered by hotels for a night stay, only later to be hit with the mandatory resort fees when they were checking in. Thanks to our settlement, Marriott now has a policy in place to be upfront and transparent in the disclosure of mandatory fees, including resort fees, as part of the total price of a hotel stay, allowing consumers to compare total costs for hotels and find the one that is the best fit for them. Marriott was the first hotel chain to formally commit to the upfront disclosure of resort fees as part of the initial advertised price. We hope others will follow. Of course, our fight against junk fees is one we cannot do on our own. We are working closely with our fellow states as well as our federal law enforcement partners like the CFPB. And I look forward to continuing to work with our partners. In the end, what we are fighting here for is basic fairness and transparency. When consumers are shopping online or in person, they deserve to understand what a loan, a house, or a vacation will cost, and exactly what key terms they're agreeing to. At the same time, all businesses deserve to compete on an even playing field, where the price is the price with no hidden surprise fees. Thank you for inviting me to testify today, and I look forward to your questions.
Thank you very much, Attorney General Henry, for your testimony and for your work on this issue. Next, we will hear from Ms. Siegel.
Good morning, Chairman Warnock, Ranking Member Tillis, and members of the committee. Thank you for the opportunity to testify on behalf of the low-income clients of the Atlanta Legal Aid Society. And thank you to Senator Warnock for your leadership and long history of fighting for low-income families, not just in Georgia, but throughout the country. My name is Lindsay Siegel, and I'm the Director of Housing Advocacy at Atlanta Legal Aid, which provides free civil legal services to families with low incomes in the metro Atlanta area. Today, I will focus on the rental housing market and how predatory and hidden rental fees gouge families living in poverty and make their rent even more unaffordable than it already is. Ms. Dixon is a single mother who found an online listing for an apartment in the fall of 2020. The advertisement said it rented for $1,400 per month. It did not list any other monthly fees she would be required to pay. She applied and paid $525 through the landlord's online portal, which covered her $50 application fee, a $175 move-in fee, and a $300 screening fee, all of which were non-refundable. She was not able to see the lease or the apartment she'd be renting, but she knew if she did not pay sight unseen, she would lose the apartment. And when her application was approved a few weeks later, the landlord charged her another $200 approval fee. She finally received and signed a copy of her lease just 2 days before she was slated to move in. It was 50 pages long and contained 8 different addenda. She had expected to pay her rent and for water. She didn't expect to be responsible for a package locker fee, a trash removal fee, a separate valet trash fee, a pest control fee, a technology package fee, an insurance fee, and a credit reporting fee. When the fees added up, $83 had been tacked on to her monthly rent. And to make matters worse, Ms. Dixon's landlord did not accept the rent by cash, check, or money order. When she paid through the landlord's online portal, she was charged another $72 per payment convenience fee. The low-income renters Atlanta Legal Aid represents have an extreme power imbalance with their landlords. The high demand for rental housing, especially at the more affordable end of the market, makes some landlords believe they can easily get away with unfair and deceptive lease terms and rental practices. The bait and switch Ms. Dixon experienced, where the landlord advertised the rent as one price, only to raise it much higher with junk fees after she had spent hundreds of dollars up front, is a far too common practice of many investor landlords in the Atlanta area. Low-income renters like Ms. Dixon become trapped. She couldn't afford to walk away from a predatory lease 2 days before she was supposed to move in, even if she realized it would be unaffordable. Of particular concern are the use of high application fees. They often far exceed the cost of running a report, and most renters have to pay them several times before finding a home to rent. We've heard reports that some institutional landlords even collect application fees after they've found a renter for an available home. The renters of color Atlanta Legal Aid serves are particularly harmed. Researchers believe the high application fees likely steer renters of color toward lower quality housing in lower opportunity areas, driving residential segregation. In Atlanta, renters who used to live in in-town neighborhoods have been pushed further outside the city to areas where schools are lower performing, transportation is more challenging, housing is lower quality, and jobs are harder to find. Although junk rental fees affect all aspects of the rental market, they place a disproportionate burden on the livelihoods of low-income families. Atlanta Legal Aid's low-income clients understand the risk of not paying rent, and the vast majority will avoid it at all cost. They will forego food, medicine, clothing, and doctor's visits. They will get a second job. They will apply for public benefits like food stamps. They will do whatever they can to avoid becoming homeless. The proliferation of these abusive fees and how common they are, particularly with investor landlords, demonstrates the need for specific protection for tenants. Stronger federal regulation could help define what is excessive and give states, advocates, and renters new tools to combat these fees. We are pleased the White House and this subcommittee are concerned about fairness and transparency in the rental market, and I appreciate the opportunity to share our clients' experiences with you today. I look forward to answering any questions you have.
Thank you very much, Ms. Siegel. Next, Mr. Johnson.
Chairman Warnock, Ranking Member Tillis, and members of the subcommittee, thank you for inviting me to testify about financial institutions' fees and the appropriate federal regulatory response. My name is Brian Johnson. I am Managing Director of Potomac Global Partners, where I advise on financial regulatory compliance matters. I previously served as the Deputy Director of the CFPB, and prior to that, I served on the staff of the House Committee on Financial Services. Today's hearing is timely. The American people have suffered from abnormally high inflation for 2 years, which has decimated the value of their savings. Because of this inflation, $1 today buys only about 86% of what it did in just 2021, which represents an erosion of over $9,900 in median household purchasing power. Indeed, without the burden that inflation has inflicted on the American family, it is unlikely we'd be here today talking about fees. The administration's decision to launch an initiative to combat so-called junk fees is an unfortunate missed opportunity to address the root causes of inflation. To date, the focus of the president's initiative has been on applying political pressure to companies to induce them to change their fee disclosure practices. In the process, the White House and supporting agencies have dismissed broad categories of fees as junk without ever providing any consistent definition of the term, which has created uncertainty as to which fees can be assessed by institutions without undue reputational or regulatory risk. The CFPB has been the most enthusiastic among regulators in heeding the President's call, indiscriminately attacking a growing list of common financial services fees, no matter that they are lawful and fully disclosed. While the President's agenda is more far-reaching than the CFPB, my testimony focuses on the Bureau's activity based on my experience there. The primary metric by which to judge the CFPB's actions should be whether the agency has adhered to the rule of law. By this objective measure, the CFPB's actions are deeply concerning. While my written testimony goes into greater detail regarding the CFPB's transgressions, let me summarize them here. The agency has publicly hectored companies about deposit account fees and used the implied threat of investigation to induce such companies to abandon these legal fees. Further, in addressing other fees, the CFPB appears to have violated its own regulations and laws governing how agencies proffer rules by disguising interpretive rules as policy statements in bulletins and issuing circulars that function as legislative rules. In another instance, under the guise of interpretation, the CFPB read a word into a statute to achieve its desired policy outcome. In still another, the agency treats the rulemaking process as a foregone conclusion, acting as though a still proposed rule has already taken effect, signaling that the agency has no interest in considering public comments, establishing an adequate evidentiary basis to support its conclusions, or considering potential changes to improve the rule. These examples demonstrate an abuse of power and the agency's disregard for process and the limits placed on it. Moreover, the CFPB's behavior subverts the authority of Congress to oversee the agency and legislate the legality of fees in our financial marketplace. Simply put, it's not playing by the rules. Some may defend the agency by saying the ends justify the means, but the CFPB itself acknowledges that these efforts harm more people than they help. For example, the CFPB claims in its proposed credit card late fees rule that it will reduce late fees by $9 billion per year. But the harsh reality is there's no free lunch, and this reduction will not achieve a net savings for consumers, but rather a cost transfer from the relatively few late payers to the great majority of consumers who always pay their credit card bills on time. I applaud the subcommittee for exercising its authority to explore the administration's efforts to reduce or eliminate what some label as junk fees. I urge Congress to look more closely at the expected costs and benefits of these efforts, both for the intended beneficiaries and for all the other affected consumers who are too often dismissed as an afterthought. Congress should pay special attention when the means used to achieve an agency's ends run afoul of the rules and laws that make the system fair for everyone. Most of all, I applaud the subcommittee's effort to shine a light on the burden shouldered by consumers under the weight of extraordinary inflation. Thank you again for the chance to discuss this important issue, and I welcome the opportunity to answer your questions.
Thank all of you for your testimony, and we'll begin with questions now. I'm going to defer to my colleague, Senator Cortez Masto's double booked, and to offer her questions.
Thank you, Mr. Chairman, and to the ranking member. Thank you so much for having this subcommittee hearing. Thank you to the panelists. This is such an important issue. I hear all the time from Nevadans, and let me just start this, because I do think there is a problem with surprise fees and junk fees. It's not inflation related. It's not because the CFPB is doing out there. There's an issue, and I hear it from my constituents in Nevada all the time. Let me give you an example. Since May of 2020, there were 123,000 eviction filings in Southern Nevada. Nearly 60,000 evictions were filed this past year. That's a 160% increase since before the pandemic. Just last month, Southern Nevada had nearly 5,000 eviction filings. Now, I know that it's not just the high rental costs and housing costs, but there were extra surprise fees that I heard from these families that were having an impact on them as well. Let me just give you an example. I had heard from families that some of these companies were charging multiple family application fees for one apartment, even when landlords knew that the apartment had already been rented. They were charging applicants for credit reports that the property manager didn't even end up purchasing or had no intention of purchasing. They were charging an application fee for minors living with a prospective tenant. Ms. Siegel, we heard from you, on and on and on. This is an issue that is happening. These are junk fees. These are junk fees. And let me just say, I over the course of my experience in housing, when I purchased apartments, I didn't deal with these fees. And I would question these fees. And who shouldn't question these fees? And I'm so appreciative that General Henry, you're here, and the AGs are looking at this as well. I guess my question to maybe General Henry and Ms. Siegel is, what can be done? Whose action is it to really address this? Is it at a federal level, or do we leave it to the states to look at addressing this as well? And maybe General Henry, I'll start with you.
Thank you, and thank you for your concern. I concur with that, and I would say this. I think it's both. Like, in terms of what Pennsylvania has seen and working with other states, we join with our federal partners and really holding these individuals accountable that take advantage of consumers, that lack transparency. And we've seen it in all different areas. You mentioned the landlord-tenant. We also have looked into that matter. It's also often first-time renters. At Penn State University, we had a case where similar conduct was happening, where landlords were charging tenants on top of their regular rent, administrative fees, and other fees that were illegal in Pennsylvania. So I think it's important that the states remain vigilant, as well as looking at the regulations that we can apply with our federal partners. Thank you.
Thank you, Senator. I think the White House press release from last week is a good first step. And the commitment that the administration got from Zillow and others to be more transparent, I think will help tenants understand what the fees are going to be and what they can afford. And it will likely lead to lower eviction rates because people will not get trapped in leases that are unaffordable for them, like Ms. Dixon did. But I think disclosure alone is not enough to protect people. Even if fees are disclosed, what we're seeing in Atlanta is they're often buried in the lease, or they contradict what tenants are hearing verbally from the property manager. So I think the federal government does have a role to play. The CFPB could create best practices, investigate junk fees further, especially those being charged for tenant screening reports, could bring enforcement actions against debt collectors that engage in collection practices that violate the Fair Debt Collection Practices Act in their collection of rental debt, especially includes collection of junk fees. And certainly, HUD could further study and address the disproportionate impact of these practices on renters and rental applicants of color.
Thank you. And Ms. Siegel, I think you mentioned this in your testimony. You assert that very large institutional property management companies are the main culprits of using junk and hidden fees to help drive profits. Can you talk a little bit more about that and that assessment? Because I see in Southern Nevada, listen, we have large institutional properties coming in, equity companies coming in and purchasing up all these rental properties. And so what data do you have that supports that statement?
I represent individual tenants, so I can't speak as much to the data as I can to my clients' experiences, but I can tell you that tenants living in Atlanta have a very hard time finding a rental, finding a home that's not owned by a corporate landlord at this point. They have bought up many properties in the Atlanta area, and they always seem to be working in lockstep, so that once one institutional landlord is charging a certain kind of fee, then another one tends to charge it as well. Just one example of this is the proliferation of landlords charging for insurance fees. And often tenants will think that these are renter's insurance because they're often called renter's insurance. But it's not like traditional renter's insurance that protects the renter and their property if it's destroyed. What it does is protect the landlord and doesn't really provide a benefit to tenants at all. And we've seen that proliferate with investor landlords in particular.
Thank you. Thank you, Mr. Chairman.
Thank you very much, Senator Cortez Masto. Ranking Member Tillis.
Thank you, Mr. Chairman. General Henry, I think you made a great point on transparency. Now, part of what we have to do is we could have a different discussion about fees and whatever you want to call them. But I think it's fair to say I can't imagine any reasonable member of Congress not saying, I want the person to know what their financial obligation is when they sign an instrument, not after they read page 10 in the fine print. So I stipulate that. I want to support that or work on that. We have similar issues in healthcare, a number of other areas where we need transparency. And Ms. Siegel, your point on the rent, I'm less caught up in whether or not a trash collection fee is appropriate or not, and more caught up in does that renter know at the point in time they're signing a lease what they're expected to pay every month. It's another example of transparency. We can discuss the fees. I mean, if one fee goes away, the rent could go up. We know that at the end of the day, they're going to try and collect enough to manage their risk and pay their own bills, the landlords. So I agree with that. I think that practice is wrong. But I'm still concerned with and we've had several references in the opening statements about the CFP could do this or could do that. But I personally think they have a scattershot and ill-defined regulatory approach right now. Mr. Johnson, can you talk about the effect of the method that the CFPB is using to go after this and the impact that the negative implications it has?
Well, thank you, Senator. I mean, the use of the phrase scattershot, I think, is apt with respect to the approach that the CFPB is using. To have any chance of success in a regulation, from my experience at the agency, you have to carefully identify a market failure. You have to come up with a proposal that's narrowly tailored to address the root causes of that market failure. And you have to undergo careful cost-benefit analysis to determine whether or not your solution is going to be worse than the problem to begin with. And so there are many unintended consequences that come when agencies cut corners, and a scattershot approach will have those unintended consequences.
One unintended consequence could be reducing underbanking or unbanking certain people because you've reached a point to where it's no longer fiscally viable for a product or service to be offered to a certain segment of the population. Is that one?
Absolutely. There's a long-standing trade-off between price and access.
Yep. Is the CFPB a prudential regulator?
It has no safety and soundness mission. It's a market conduct regulator like the SEC or FTC, who are appropriated by Congress.
If you take a look at the CFPB's efforts on overdraft fees as an example, after the 2008 financial crisis, some regulators under the Obama administration emphasized reliability and countercyclical nature of overdraft revenue as an appropriate tool for ensuring the stability of the bank's balance sheets. Some at the Federal Reserve went so far as to express a desire to see overdraft revenue when grading banks on well-known CAMELS rating system. Yet now the CFPB has undertaken a name and shame campaign to coerce banks who were following the established prudential standards for the crime of listening to their previous federal regulators. So does the CFPB have the proper jurisdiction, resources, or staff to make prudential regulatory decisions?
No.
Is the CFPB's tendency to name and shame business institutions to avoid certain practices or adopt new ones effective regulation?
It's not, and I would add that, this tactic of using the implied threat of investigation to coerce lawful businesses to change their practices for political purposes should be condemned.
Do you believe the Bureau thinks these implications or conducts sufficient analysis on the follow-on effects of their junk fee regulations? Or you more or less answered that in a prior question. They're not really thinking through the full impact and all the potential unintended consequences. Can you think of any example under this current leadership of the CFPB where they have taken that into consideration?
Well, I mean, they are moving forward at least with the rulemaking and credit card late fees, but the problem with that rulemaking is the Bureau admits that it lacks the evidence to understand the effect that the regulation will have on small card issuers. Mm-hmm. And rather than going to get that evidence through, for instance, the Sabrifa panel, it simply declined to do so.
Mm-hmm. Mr. Chair, I thank you all for your testimony. Mr. Chair, I'd like to submit for the record a letter from the Consumer Bankers Association on the subject.
Without objection.
Thank you.
So I'd like to go back to something that Attorney General Henry was talking about earlier. You talked about the case in Pennsylvania where a finance company allegedly engaged in egregious tactics to impose hundreds of dollars in hidden financial products for consumers. You talked about how that company would mail checks to folks who are struggling, and then when consumers cashed them, they automatically opened a loan and discovered that they were paying these add-on insurance products over and over again. You've been vigilant going after these bad actors in that space, and in this case, against Mariner, Pennsylvania partnered with several other states, and you've said in your testimony and in your answer that you think there's a role for states to play as well as the federal government. Let me ask you directly, how often do these kinds of cases cross state lines, and would having federal standards against these types of hidden fees make these cases easier to bring?
Almost always. And I think that's critical. I mean, where we have been most successful is joining with our fellow states, other attorneys general, and partnering with them, and including the CFPB. In December of 2020, the CFPB, with all 50 states and the District of Columbia, filed an enforcement action, for instance, against Nation-Star Mortgage, again, for deceptive practices, for not being transparent, and when they were servicing borrowers' mortgages. And as a result of that joint effort, we were able to obtain a settlement of $73 million and brought aid to 40,000 borrowers. So typically, and in the practice of what we do at the Attorney General's office, is we often see things bleed over state lines and boundaries, as you are well aware. And so it's important that we work together to enforce these matters.
Do you think consumers know what junk fees are?
I think consumers are hit with them, and they often don't understand or see. And as you raised, the reality is a lot of times consumers get misled. So they're looking on the internet, they're trying to do due diligence and look for the best price, whether it's for a hotel, a vacation, and they're examining it, and they get led to a certain area, a certain website, thinking that's the best price, and they go down this rabbit hole where they have no idea at the end of it that the price they thought they were going to pay for a hotel stay with their family is actually far larger because of fees that they weren't prepared or were not properly advised of. And at that point, they're so far in, or they never discover it. So no, I don't think they understand exactly what to be aware of. We're trying to do our best to educate, but far more work needs to be done, and I applaud this committee for working on it.
If more federal agencies had the authority to address these hidden fees, how would that affect your office's capacity?
It would help tremendously.
Thank you so very much. Yes. Senator Smith.
Great. Thank you so much, Chair Warnock and Ranking Member. I really appreciate you holding this hearing, and I'm glad to have a chance to be here to see all of you and ask some questions. So I want to focus on the issue of some of the exploitive practices we are seeing around land contracts. Earlier this month, I chaired a hearing in my housing subcommittee on land contracts. So these are arrangements such as lease to purchase or rent to own agreements that can be highly exploitive, and they often target home served communities, particularly in the state of Minnesota. These targeted at many people in the Somali community. So the terms of these arrangements are often misrepresented or not fully disclosed, which means that buyers are facing unexpected fees and penalties, which only compound their challenges. And this can be a big deal. So what this is essentially somebody enters into a contract, as you know, where they are leasing or renting to own, but they don't end up owning the property. And if one thing goes wrong, equity that they have put basically, and this can be one of the hearing testimony organizations help folks in this process have 130,000 in penalties and fees and charges for 40 families. So really significant. To what people.
It was exactly as you described. Consumers were attempting to be able to get property and rent to own, and in the end, again, it lacked transparency.
Right.
So the details are buried deep, where they're never fully explained, and the fine print allows them to take away the equity that these individuals up with with some minor transgression, and they're completely unaware. And again, a critical piece to this is that these are up individuals, exactly what they're signing up for into, and based on that, as opposed to and then to lose and owe so much more money. It's a vicious cycle that as not being up front.
Right, and I know attorneys general around this, and this idea of increased transparency has been brought up as a solution, has been to the way that this occurs for people is with complete forfeiture rather than any kind of process. And so I wonder if maybe, Ms. Siegel, if you'd like to comment on that, or if anybody would like to comment on that.
Thank you, Senator. We do see those types of cases at Atlanta Legal Aid, often called contract for deed or
Yes.
rent to own. What we see is that tenants do, or potential homeowners do often forfeit any potential equity that they may have had after paying. Also, fees and monthly. Some of these rent-to-own companies say that those fees are refundable. When you look at the fine print, you find that they actually forfeit all those fees if the tenant isn't ultimately able to purchase the home. We also find that there are very high failure rates. Not many people that come to us are actually able to become successful and become homeowners at the end of the day. And we think it's problematic.
The testimony before our subcommittee really talked about how, in many ways, these contracts are designed to fail. It's not just like, oh, it's just not working out most of the time. When it's 80, plus percent of the time they're failing and people are losing their all of their equity, then it's designed to fail. And that is, I think,
Also point before I yield back, Mr. Chair, that in some parts of our economy, and in Minnesota, for example, contracts for deed are used by folks in agriculture, young folks that are getting into buying land, and they can be used in a non-exploitive way. But it is this, the ways in which it is these contracts are being used to really take advantage of people, I think we need to focus on, and there's a lot that we can do. Thank you, Mr. Chair.
Thank you very much, Senator Smith. Senator Warren.
Thank you very much, Mr. Chairman, and thank you for holding this hearing today. So earlier this month, the Consumer Financial Protection Bureau ordered Bank of America to pay $100 million to its customers for illegally charging fees, withholding credit card rewards, and opening fake bank accounts. Now, I know what you're thinking. Fake accounts, illegal fees, fraudulent credit card practices. I've seen this movie before. Is this deja vu all over again? Name your favorite big bank: Bank of America, Wells Fargo, JP Morgan Chase, and chances are that the CFPB has caught them red-handed engaging in any one of these tricks, at least one, and sometimes all at the same time. Consider overdraft. Overdraft fees, the charge you get if you spend more money than you have in your bank account, squeeze as much as tens of billions of dollars out of consumers' pockets every year. The banks claim that these fees help consumers by allowing banks to offer overdraft protection to those who want it. So, Attorney General Henry, you have spent years prosecuting consumer protection violations. You're someone who has seen up close the junk fee tricks that financial institutions use to nickel and dime consumers for their last buck. So let me ask you, are these fees good for consumers like the banks claim?
Thank you for the question. No, they're definitely not good for the consumers. In fact, in April of 2022, we urged the biggest banks to follow Citi and Capital One to eliminate harmful junk fees, overdraft fees, non-sufficient fund fees. And, the truth is they hit families of color harder and often result in account closures, leaving them unbanked. 90% of these fees are paid by a small subset, and they generally pay 3 or more a year while earning less than $50,000. And the truth is, typically the cost of the bank to cover unfunded transactions is far lower than the fee that they're.
So as I understand it, the fee to the consumer can be as high as $37. And you're saying the actual cost to the bank?
Much less.
Much less than that. For Bank of America, hitting consumers with a single $35 overdraft fee wasn't enough. They were caught double dipping, charging multiple fees for the same transaction, earning them hundreds of millions of dollars over a 3.5-year period. Now, banks know that these fees are junk, and that's why many of these banks recently announced changes to their overdraft policies. At the same time that Bank of America was breaking the law, it made a splashy announcement early last year that it would lower its overdraft fees and reduce its overdraft-related revenue by 90%. But the fact of the matter is that Bank of America still took in nearly $400 million in overdraft fees from families last year. And altogether, big banks raked in more than $7.7 billion in these fees. Now, Attorney General Henry, now that we know that $7.7 billion, we know, is not a ton of money to a big bank like Bank of America, it's just icing on the cake for them. But it's a lot of money to low-income families that are forced to fork it over. Do you believe that the big banks like Bank of America should eliminate overdraft fees?
Yes.
That was very direct. Good. I'll take that. Despite continuing to rake in billions in revenue from predatory overdraft fees and continuing to get caught charging these fees illegally, the bank lobby holds up the changes they've made to their overdraft policies as evidence that these giant banks can be trusted to do the right thing on their own and that they don't need stronger rules that would protect consumers from predatory overdraft fees. And let's not forget, these are the same banks that are bankrolling the attacks on the CFPB. So, Attorney General Henry, given their propensity for repeated law breaking, do you think the giant banks can be trusted to act in the best interest of consumers without stronger rules and vigorous enforcement?
Well, if history is any lesson, we know that they can't be trusted to act in the best interest of consumers on their own. Look, they're in the business of making money for their shareholders, and we need robust consumer protection rules and enforcement to ensure that.
Yeah, I have no problem with the banks making a profit, but not like this. The big banks have proven over and over that they will abuse their power to no end in their endless pursuit of profits. The CFPB has shown that it will stop them in their tracks, and we need to keep it that way. Over the past 12 years, the CFPB has returned $17 billion to American families cheated by financial institutions, money that otherwise would have stayed in the pockets of Wall Street executives. I am proud of the work that the CFPB has achieved, and I look forward to working with my colleagues to support their work in the future. Thank you, Mr. Chairman.
Thank you very much, Senator Warren. Ranking Member Tillis.
Thank you. Just a brief question and a statement again to General Henley and Ms. Siegel. What you're witnessing here, I think, is not members saying that we shouldn't have transparency, that the people, that a consumer should know what it costs at the time that they make a financial commitment. What we're really having a discussion here is, I think Chair Warnock or one of the members suggests that we just need to give the regulators more authority. So what we're talking about here is not the what, it's the how. And I, for one, do not think that the regulators who have demonstrated pushing the boundaries of their authority, giving them more authority, is a good idea if we're coming up with a real bipartisan sustainable solution. I think that comes by saying the practices that you demonstrated are wrong. How do we deal with that? And as a matter of Congress, how do we agree that that should look? The problem we have here, too, when we transfer power out of Congress to another branch, is that it changes every 4 years or so. So you may be thrilled with a regulatory regimen that comes out from the CFPB today, but because of the way they behaved, it'd be one of the first things I would work to repeal if the administration changed and withdraw it. So I think we have an opportunity here if we realize that there are probably extremes at either end who are not going to be satisfied, but the problem that you all identified has been addressed. I think it should be the purview of Congress. So, Mr. Johnson, can you speak a little bit about the efforts and the lengths the CFPB goes in an effort to avoid judicial review and skirt the APA process? Because that provides a little bit more context for behaviors that concern me about empowering regulators to do more. But if you could just give a few examples, and I'm done, Mr. Chair.
Thank you, Senator. So as you know, the APA requires agencies to go through a full public notice and comment process to solicit the views of the public regarding a rule proposal. And that process takes time, although it's incredibly important to do so. So for some agencies, there's an incentive to skirt that process because it takes that time to go through that careful deliberation. And so we've seen trends of agencies like the CFPB issuing guidance. For instance, the CFPB's new form of guidance called circulars, which are meant to advise other enforcement agencies of the
Does the industry view that as guidance, or do they view it as a de facto rule that they better adhere to?
It's viewed as a de facto rule, and that's the game that's played, which is labeling it as a statement of policy as opposed to going through the full rulemaking process, but banking on the idea that industry will treat it as a mandatory obligation.
By not going through the full process and notice and public comment, aren't we missing the opportunity to identify some of the very unintended outcomes that consumers may ultimately bear the burden of?
Absolutely, and Congress has specified that the CFPB has to go through a fulsome cost-benefit analysis under Section 1022 of the Dodd-Frank Act.
Thank you.
Mr. Chairman, might I ask a question?
Yes, by all means.
I'd like to follow up with the same witness. Is the CFPB the only agency that issues guidance?
It's not. In my written testimony, I point out the trend that the agency...
You have data on the trend.
Well, I've pointed out several instances of guidance in my
Anecdote, the plural of anecdote is not data. You have data on the trend?
I've pointed out the instances of the CFPB's efforts with respect to the President's Junk Fee Initiative, which I think are skirting APA requirements.
So the question I was asking you, is the CFPB the only agency that does guidance?
No, and to be honest,
Senator, it's not.
If I may answer that question, no. Several of them do, and Senator Warren, it's one of the reasons why when we see guidance, speeches, memos, letters, suggestions that we think ultimately rise to a rule, we get an accounting of that, and we try to have that particular policy position withdrawn or just subject it to the Administrative Procedures Act.
Well,
it is rampant in the financial regulators. So no, it's not just about the CFPB.
And that's my only point, is the CFPB, the OCC, the Fed, the IRS. Guidance is a part of how they explain to the industry the agency's view of emerging practices, for example. If there is a problem, I'd really like to see the data on it. Thank you.
With that, all questioning has concluded. Look, I would invite our colleagues on the other side of the aisle, if they feel that something is amiss here and they're interested, they think Congress needs to get involved. I look forward to their suggestions about how we strengthen regulations to protect consumers. I don't think they can wait another day as we deal with whether talking about housing in Atlanta or the bank fees that others face all across our country. Thanks to our witnesses for being with us today. Thank you again to Ranking Member Tillis for your partnership with holding this hearing. And this is the Senate Banking Committee's first hearing on junk fees this Congress. I look forward for more to come. This hearing highlights how Congress and this administration are focusing on lowering costs for the American people. There is a difference between offering a service that will lend a hand and offering a service that will kick someone while they are down. I am grateful for the work that the CFPB and the FTC are doing to tackle predatory junk fees. Clearly, there's a lot more work to be done in this space. Lowering or eliminating onerous fees is something I will keep pushing for through legislation, by working with the business community when necessary, and by working with regulators to stop bad actors from taking advantage of working Americans through rulemaking, as well as by providing guidance. This topic is about saving people money, creating an economy that works for all Americans, and ensuring that hardworking families are not swindled out of a shot at financial stability. For senators who wish to submit questions for the record, those questions are due 1 week from today. For our witnesses, you will have 45 days to respond to any questions. Thank you all again, and with that, this hearing is adjourned.